Hey everyone, it's Alan back again with another video, and today I wanted to highlight one of my favorite income-producing stocks out there and just present my analysis on Ares Capital to you all and talk about why I personally believe that this is a pretty solid company and will continue to be so in the future. This is the same stock I discussed in my last video, in which I explained why if you want to live off passive income now as opposed to in 20 years, you should be targeting higher yielding investments, with Ares Capital being an example. Before I get started, if you're interested in high-yielding investments where you can earn a large amount of passive income, please consider clicking the subscribe button below. Dividend Bull revolves around aggressive dividend investing for people who want to live off passive income sooner rather than later and realize that dividend growth investing isn't going to allow you to live off dividends unless you're willing to wait 20 years or you already have $1 million to invest right now. Thank you all so much for your consideration, and with that being said, let's get into it. Ares Capital Corporation is a business development company that specializes in the acquisition, recapitalization, restructuring, rescue financing, and leveraged buyout transactions of middle market companies. Ares Capital typically makes investments in companies in the manufacturing, business services, consumer products, healthcare, and information technology service sectors. The company typically makes investments ranging from $20 million to $200 million and seeks board representation in its portfolio companies. Ares Capital was founded in 2004 and is headquartered in New York City. If that description sounded really confusing, what you need to know about Ares Capital is that it's a BDC, or a business development company. A BDC is basically an investment company that invests money into small and medium-sized organizations. The funding that a business development company provides allow these smaller businesses to grow during the initial stages of their development. BDCs have only existed since 1980, and from what I could find, there's roughly about 50 BDCs out there that are publicly traded on stock exchanges. And so when these businesses they invest in make money, they pass some of the profits back to the BDC as per whatever terms they agree to, and then the BDC has to pay out 90% of their earnings in the form of dividends to shareholders. Now maybe you're wondering why business development companies need to exist in the first place, since there's so many different funding options out there for companies of this size already. It might seem like BDCs aren't exactly necessary since, for example, these companies could go to a bank, they could talk to venture capitalists, they could go public, they could potentially crowdsource if they're not too big, etc. Well, the fact is, a business development company can offer more flexibility to these small and medium-sized businesses than, say, a bank could. It's possible that some businesses don't like the terms that a bank offers them, or it's entirely possible that the business might not be quite big enough to go to Wall Street yet. Additionally, some BDCs offer funding to distressed companies, meaning that they offer money to businesses that are struggling to survive. And so for that reason, BDCs are typically treated as being riskier investments. In a few ways, business development companies are actually really similar to REITs, or real estate investment trusts. Only instead of investing in real estate, BDCs invest in businesses. Both types of companies are required to pay out 90% of their earnings to shareholders in the form of dividends, and income received from both are classified as ordinary income as opposed to qualified dividends. While most income investors are familiar with REITs, fewer are familiar with BDCs, probably because not only are they a newer type of investment, but they're often viewed as much riskier than REITs as well. But in return, what we get as investors are extremely attractive dividend yields. Right now, Ares has a dividend yield of 8.91%, with its next dividend being paid out on March 31st of this year for 40 cents a share. According to the dividend history for Ares, we see that it's been at 40 cents per share for the past year, and historically there has been a slow amount of growth in its dividend. There was a period during the 2008 financial crisis where the dividend was cut, but it's slowly been increasing since that time. The key to any BDC's performance in determining the safety of its dividend is how well the companies they're invested in are doing. Much like a REIT, if a BDC isn't receiving cash flow from the businesses they are invested in, it can affect the amount of dividends we receive as investors. This makes it really important to take a deep look into any BDC in order to analyze what they're invested in and determine if it's worth the risk of holding some shares in our stock portfolios. This is where Ares Capital really shines when compared to other business development companies. Ares Capital is the largest BDC in the industry, with investments in over 350 companies and a portfolio of roughly $15.5 billion as of December of last year. If we look at their portfolio on their website, we can see that Ares is a very well diversified company in terms of the industries they invest in and the geographical locations of the companies they invest in. As you can see, Ares Capital's largest holdings are in industries that aren't as impacted as others during the COVID pandemic. A lot of their industries are in the service sectors, so things like healthcare, software, commercial and professional services, among others. The good news is that they're only invested in a very small amount of industries that are more impacted from COVID. So for example, only 1.9% of their portfolio consists of retail and distribution, and only 2.2% of their portfolio consists of food and beverage companies. Ares Capital's well-diversified portfolio is a huge advantage this company has over other BDCs. I've seen some other BDCs, like PennantPark for example, ticker symbol PFLT, that have less than 30 companies in their portfolio, whereas Ares has over 350. As investors, we know that the more diversified your portfolio is, the less impacted you'll be if one or even several of those companies fail. And since BDCs, as previously mentioned, are risky by nature, this large diversified portfolio adds a huge layer of protection that puts this BDC in a category of its own. You can feel free to check out their portfolio of investments on their website. It's a really long list, but just to give you a brief overview, they got a lot of diversity in their portfolio. They're invested in dental companies, medical supply providers, insurance companies, supply chain software management, disaster recovery services, employee benefit providers, cloud-based software, among others. As you can see from Ares Capital's stock performance since inception, there hasn't been a lot of growth since it was first launched. This is a universal negative when it comes to BDCs. When you invest in them, you're not going to see hardly any capital appreciation in your initial investment, even after 15 years. But remember, being able to generate a huge amount of income every quarter is one of the key benefits in pursuing a company like Ares. You might have noticed the two dips in their stock's performance since their inception. These two dips were during the 2008 financial crisis and the COVID pandemic back in March of 2020. However, if you compare this stock with literally any other BDC, you'll also see that, as a whole, BDCs struggle during these times as well. Some news sites like this one in particular criticized the industry for tanking so much back in March, but as you can see, a BDC like Ares that's so expertly managed has almost fully recovered since then. On top of that, Ares just announced their fourth quarter earnings, and it was filled with a lot of good news. They were expected to post 40 cents per share in quarterly earnings, but they actually posted 54 cents per share in quarterly earnings. To compare that with the same quarter a year ago, Ares posted earnings of 45 cents per share. This shows that the company has been recovering very nicely since the pandemic started, and that as long as things don't get much worse, it appears that things are going to continue to go their way. To sum up everything we've looked at, if you're interested in adding a couple BDCs to your dividend portfolio, I think that Ares should definitely be on your radar. Ares has a great management team and a very well-diversified portfolio in a lot of industries that are less impacted by bad economic times. They're one of the handful of BDCs out there that have continued to see a good amount of consistent growth in their dividends over the past few years. Another BDC I'm a huge fan of, if you're interested, is called Newtek, ticker symbol NEWT, which I covered in another video about a month ago. Newtek is great because it's not like other BDCs out there. They do a lot more than just invest in companies. They offer a wide range of crucial business services, so things like payment processing, insurance, and all these other services that help create a moat during bad economic times. Feel free to check out that video for more information. I'll have it as one of the buttons on the screen at the end of this video. Alright guys, that's going to do it for today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the thumbs up button below, and also feel free to subscribe to the channel for more content revolving around high dividend stocks and ETFs. Let me know in the comments section what you think about Ares Capital. Do you like it? Do you not like it? Are you a shareholder or not? Feel free to let me know, and also feel free to check out some of my other recent videos, such as the top 5 highest yielding monthly dividend ETFs, as well as the top 5 highest yielding REITs out there. Okay, thanks again guys so much for watching, and I'll catch you next time. Take care.